Now let's look at the trading account. Okay, not all companies prepare the trading account. The trading account is prepared by manufacturing and trading companies only. To be specific, the companies that engage in the sales and purchase of goods prepare trading accounts. And as such, trading account is related to manufacturing transactions only. Service provider firms do not prepare this trading account. For example, a company that manufacture cars, they prepare the trading account. And if you have a company that provides software services, they do not prepare the trading account. Okay. The transactions related to manufacturing are captured in an account called trading account. Let's get deeper into the trading account. Okay. So you may ask, why is trading account important? Why only for manufacturing related firms? Trading accounts is an important statement from cost point of view. Okay. With the help of trading account, firms can get to know which particular product is earning profits and which one is making losses. Trading accounts help the firms to maximize the profits and cut losses, right? Management of the firms are particularly interested in the trading accounts. And also it helps the sales tax authorities to know the purchases and the sales that are done by a company, and accordingly they would levy sales tax for the sales that the company is showing in their tax returns. So what does a trading account contains? A trading account takes into consideration the raw materials, the semi-furnished goods, the fully finished goods as an opening stock for the accounting period. Semi-furnished goods are nothing but partly finished goods. For example, a product preparation can go through many stages of processing. Let's say a product goes through 5 processing stages to become a fully finished product. If the product has gone through processing partly and not completely through all its stages, then it is called as semi-furnished goods. And we have fully finished goods, which are nothing but the goods that are ready to be sold in the market. And we have raw materials. Raw material is nothing but the material that is purchased to make the products, which has not yet gone through the processing. Okay. So in progress goods is nothing but the work in progress goods that is currently going through the process in the manufacturing plant. Okay. So opening stock or the opening inventory means the same thing. For those who are not aware, opening stock is nothing but the amount or the value of materials a firm has or was available to use at the beginning of the accounting period. Opening stock is equal to cost of goods sold plus ending inventory minus purchases. Okay, this is a simple formula that can be used to calculate the opening stock. So a trading account takes into consideration opening stock for the accounting period. As I just said, we're taking into account the opening stock, right? But what about the closing stock? Yes, we also need to take into consideration the closing stock. What is the difference between the opening stock and the closing stock? As I just mentioned, the opening stock is the amount of material or the value of the materials a firm has or was available at the beginning of the accounting period, right? Similarly, the closing stock is the amount of unsold stock lying in your business at the end of accounting period. In simple terms, it's the inventory which is still in your business waiting to be sold at the end of accounting period. The stock which was not sold is valued and they come up with the number. That number is called closing stock. And the closing stock can be in various forms such as raw materials, semi-finished goods, and in-process goods. Okay. So I repeat again, closing stock is whatever the stock that is unsold at the end of the accounting period. So if you observe carefully, the closing stock of the previous accounting periods would automatically become the opening stock of the current accounting period. Okay, I'll explain it with an example. Let's take a car manufacturing company from India. They manufacture cars throughout the year, right? So they do the sales throughout the year. We learn that the accounting period for India starts on April 1st and ends on March 31st. And on March 31st, end of the day, whatever the stock that was unsold, including the finished cars, including the semi-finished cars, the raw materials, the car company will calculate the amount of the unsold items and it will show them as closing stock for the financial records. Once they show this closing stock in the financial records, do they throw out these closing stock items because they were unsold in the period? No, right? Because it is money. Okay, at the end of the day, it is money. No one can throw money just like that. They just use it for the next accounting period. And when they start the next accounting period from April 1st, they would mention in the books that this is our opening stock for the year. So basically, the closing stock of the previous accounting period becomes the opening stock of the current accounting period. Now, one question should come to mind. How do companies get to know the value or the amount for the closing stock? The closing stock or the opening stock is valued at cost price or realizable value, whatever is less, whichever is less. Let's say the company is showing the value of closing stock on March 31st as $2 million. On April 1st, they would show the same value of opening stock as $2 million. Okay. So they just need to come up with the cost of closing stock, and that closing stock we anyway know is going to become the opening stock value too, right? It's just the day end. On March 31st, the accounting period closes. On April 1st, the accounting period starts. So there is no gap in between, if you have to say so. Okay. Now we discussed the closing stock and the opening stock. So what else goes into preparing the trading account? A company would be making some purchases in the year, right? So we need to take the cost of the purchases. While we make some purchases from the vendors, companies sometimes do return the material back to the vendors due to quality issue or whatever reason, right? And the vendor pays the money back. Whatever you're returning, that is called as a purchase return. Okay, because you purchased it but you're returning it. So that is how it is called, purchase and purchase return. Okay. And now, so what is the total value of a purchase? You have to remove the amount that you received for the purchases return from the amount you paid earlier. That gives you the net purchase value. Okay. Similar to purchases, we need to consider the sales figures. As a company, they make sales throughout the year. They get money from the sales. But the company also gets some of its products returned, right? Like we have returned some of the products to our vendor, some of our customers may also return some of the products that are not fit for the purpose for reasons like quality standards or whatever reason it could be, right? So what we do is we give them the cash back for the returns that they have made, correct? So if we have to come to a net sales value, what we have to do is we have to take the total sales minus the returns we have made, because we have to return the money to the customer, right? We need to deduct that money. So far, we've considered the closing stock, we've considered the opening stock, we've considered the net purchase, we've considered the net sales, right? So we also need to consider the direct costs associated with the purchase of goods or the sales of goods. Remember, we only need to consider the direct costs related to the purchase, manufacturing, or sales of goods, not any of the indirect costs like advertisement costs or some back office administration costs. Only the ones that are directly associated with the production and selling of the goods. So like we have direct costs, we would also be having direct revenues. You might get confused, what is the direct revenue and what is the sales? What is the difference between them? Well, sales is the sales of the product, but direct revenue here is associated with the sales of the product. Let us say a company sells a product, but it will charge to fix that particular product, right? It is a service charge that the company is charging its customers. This is an extra revenue coming directly, which is linked to the sales of the goods. So we need to take into consideration the revenue that we are getting directly from the sales. Just not the sales, net sales, but also the revenue that is linked to the sales. Okay. We could have mentioned other revenue, but other revenue which is not associated with core operations is not called direct revenue. That's the reason we are saying direct revenue here. Okay. So once we take all these into consideration, how do we do the calculation? So what is the formula? Well, the formula is simple. You need to sum up the net sales and the direct revenue and the opening stock, and then you need to remove the net purchases, cost of goods sold, and the closing stock, and that will give you the gross profit. Okay, net sales plus direct revenue plus opening stock minus net purchases minus cost of goods sold minus closing stock and it will give us the value of the gross profit, right? So if you observe carefully, trading account is helping the manufacturing firms come up with the gross profit for the product itself that is being manufactured. So the management of the manufacturing industries are extremely interested in this because they know how the product in itself is doing, whether the product is profitable or not, or if they want to increase the profits, what do they have to do, things like that. Okay, so this completes the trading account. Now let's get into the financial statements. Okay, if you have understood all the concepts explained from the beginning till this point, trust me, financial statements is just a cakewalk for you. It is very easy to comprehend.